Hey guys, Killstokes here. Yesterday I shared with you an extremely long video showing you all the trading opportunities that are on my radar for the week ahead. Today I want to share with you a very short video re-examining one of the concepts that we went over. By the way, love the feedback. Glad you guys enjoyed the longer video. Maybe we'll do that more often if I continue to have time. But in the very first setup that we looked at, I mentioned something called the stop and reverse, and I went over it very briefly in order to save time, and I did get some questions about it, so I want to go over it in a little more detail right now. That way it makes 100% sense. 100% sense. Does that make sense? I don't know. Words are never good for me, but just to recap, and I'll do this really quickly because I'm assuming you saw the previous video, and if you didn't, just go back and watch it, or at least the first, this part of it. But we were looking for two things here on the pound dollar 4 hour. One was a potential bearish bat pattern, which looks something like this, waiting for price action to get to the 886 Fibonacci retracement and looking for a bearish opportunity somewhere in this zone. I'll put an emoji on because these things are cool and I like using them. Growl. There we go. The second trading opportunity was actually a bullish flag pattern, right? And that came from this move right here. A directional move from our swing low to swing high right there, and then an inward slanting consolidation, which gives us our flag pattern, which would be a bullish opportunity. Now, we spoke about how you can trade the bat pattern in its own right, completely separate to anything else. We spoke about how you can trade the flag pattern in its own right, completely separate to anything else. And then we said, if you want to get fancy, and somehow my accent changes every time I say the word fancy, you can do both using a method called a stop and reverse. And here's what that means. So let's say you're someone who is taking the bullish flag pattern, right? And you are buying one unit, right? So let's just say you are buying +1. That means one unit, that's one contract, whatever that means to you. One mini lot, one standard lot, 5 mini lots, 5 standard lots, whatever it wants. It's one, you're buying one. Just let's keep it simple here. Now, real quick, what's interesting here is that if you were to look at Fibonacci-based patterns for the flag pattern, Fibonacci extension from our flagpole, swing low to swing high and back up, you're going to see that we have a 1618 Fibonacci extension at the top of our pattern or advanced pattern zone. Or if we took a Fibonacci extension from the swing low here, the C leg, up into our most recent high here and back down, we're going to have a 127 at pretty much the bat pattern completion. So just interesting that both of those patterns line up at the same place. The point is, if you are buying the flag, you are probably looking to take profit somewhere around this area. So the same area in which you're looking to take profit at would be the same area that our bat pattern traders are looking to get involved in. And if you're someone that's looking to go directly from one scenario, buying the flag, to selling the bat pattern, what you would do is, right, in a normal situation, if you wanted to get out of your bat pattern, right, you bought one down here, so you would be selling one up here. Hope that makes sense, right? You buy one, that puts you in one long. Now you sell one, that takes you out. You make your money. It's all good. However, if you wanted to go directly from this buying into a short position, what you would do is you would sell two. And this is what that stop and reverse does, right? So as you come up here and get to whatever level you're planning on selling at, right? What you would do is you would set up a sell limit order to sell two. And what that would do is, one would give you profit on your original buy, and then the second order would put you short, right? Gotta click it on here. The second order would put you short, here we go, 1 unit to the downside, which is what you'd want to be in the first place, right? Hope that makes sense. So when we talk about stop and reverse, it's pretty much setting up your orders so that you go to directly one point. You don't have to redo any orders. You don't have to wait for anything. You just kind of do like a U-turn. You go strictly from one point and then you reverse, and then you're down in the opposite direction. It is a cool technique if you find yourself in a situation like this where you want to be in both trades, and obviously both trades meet your rules. But I would also say that mentally and psychologically, it can also be very tough because it's kind of like, catching the falling knife, right? Everything is going in your momentum, you're going up, you're going up, you're going up, you're exiting a trade, which you always have fear that you're exiting too early and they might go on further. But not only are you exiting, you are getting involved in the opposite direction. And I can tell you from personal experience, right? If this thing doesn't reverse exactly where you thought it would, and let's say it rallies up just a little bit further than that initial order, you're going to start freaking out a little bit. You're going to start saying, why did I exit? I should have kept my first position and made more money. This is bad. And all those psychological demons may come in. So just keep that in the back of your mind when you're doing it. But it's also a really, really cool trading technique. And when you land it, you feel amazing. So hope you guys enjoyed the brief explanation. If you guys didn't see the long form video, make sure you go back and watch it. It is 45 minutes of trading goodness. And I wish you guys the best of weeks in the market. And until next time, plan to trade, trade your plan. Take care.